Welcome to the Softland Central podcast, your home for market entry knowledge and resources. Softland Central is brought to you by Softland Partners, an online marketplace to help you find best fit resources for your market entry. Find them at softlandpartners.com. Hi, and welcome to the next episode of Softland Central, the home of market entry. So today we are really thrilled to be getting into a topic around alternative funding for U.S. market entry. And we have Brian Frumberg and Nathan Coffey here with us from VentureOut. Welcome, gentlemen.
Thanks, Bill.
Thank you, Bill. Very excited.
Yeah, it's such a cool topic. And I have to maybe just set the stage a little bit. And we all, it's certainly in what you guys do. And I get the privilege periodically of mentoring it in various programs overseas. And we're always working with international companies coming into the U.S. And there's this sort of notion that companies expand to the U.S. to get U.S. capital and get access to great venture capital and the various funding networks. And it's so interesting because obviously the percentage of companies that actually ever get venture financing is so small, and it just seems like a really risky way to build a business plan based on such small percentages. So what we really, I think, want to explore today is, I think probably twofold. One is, what's the path, if that is the right path for you, what's the optimal way to sort of go at it? And then two is, if maybe there's a better path than having your first priority raising money. Instead, are you ready to raise money and all that? And how do you look to the U.S. venture market in your current state, and how might that be improved? So, let's hop into it. And maybe Brian, I'll start with you, and that is, let's talk a little bit about companies that are entering the U.S. market. I guess, what do you see in terms of the challenges that they're presented with in terms of funding?
A lot of them. And not to discourage, like a lot of what we focus on. And when I first started VentureOut, the entire idea was built around it's really hard for companies to expand for startups. Innovative tech startups to expand here, certainly to raise capital. And there wasn't anyone focused really on supporting them, definitely not at scale in the way that we started doing back in 2012, 2013. And so trying to sort of crack the nut of how does a company from Europe, South America, APAC come to the US, successfully launch and raise, I think, part of the misconception of, you have to come to the US to raise money is built around dynamics that have changed over that time. What I mean by that is the availability of risk capital outside the United States has grown tremendously since I started doing this. And so the viability for a company to be able to raise at home or in a market that's closer to home, where there's less sort of like geographic risk in the eyes of their investors, has grown. The viability of that is much higher than it was when I started doing this. When I started doing this, there was very little risk capital, even in most of Europe, right? With the exception of like London, which was, I think, when I started doing like 25% of the VC deals in dollars that New York City was doing. And New York City was 1/8 of Silicon Valley at that time, right? And so that's changed, right? And London was the biggest market outside the US. Then that's changed drastically. Like New York's more than half of San Francisco, London's exploded, as have a lot of other communities in Europe and beyond that. But I think that like legacy thought is the reason why that still lives within a lot of people as an assumption. But I think the first assumption you mentioned is really important one. It's the risk of going down that path. And I think you had framed it as, man, that's a really risky path to go down because it's not likely, right? Like the success rate is really low. I would frame it differently. There are risks of working with venture funding, right? There was and I'm not going to attribute it to the right person. I don't remember who I heard said this. It's just, I'll be honest and say it's not me. But there was a metaphor for venture funding, which was comparing it to life support, right? And as long as you are dependent upon venture funding, you are dead in the water without it. You are unable to survive. And so if you are not able to leverage the funding you receive, assuming you get your first round, right? If you aren't able to leverage that funding to then hit the metrics needed to hit your next funding round, your business is essentially done. And so the first question we always ask is, should you raise money? Because again, another big assumption is, oh, well, I'm starting a company, I need money to fund it, right? And that's just not true. It's also highly expensive to have people take ownership of your business. And it feels cheap in the beginning because you have no money. So money's of great value and your company's worth essentially zero. So the equity seems like it's of low value. But that switches pretty quickly if you get traction. And the perspective of founders immediately goes to like hoarding their equity in favor of taking money for it. And so it's just a really important question to ask at first, because most companies aren't a fit for venture funding, right? Most companies aren't going to scale in under 8 years to be able to go public or to a valuation of over 100 or 150 million or $300 million. And that's what most like venture capital funds are looking for in terms of scale and then exit possibility for their investments. And so, the companies that really are a fit for it, we generally see fitting into one of two categories. They need the funding in order they want to go on that rocket ship. That rocket ship pathway. They want to try to explode and build a $1 billion business. And the only way you can do that rapidly, right? Organic growth to $1 billion is a slow game. And anyone that's able to do it, you own like 90% of your company by the time you get there, and you are as rich as anyone else on the planet ever has been. But it's not going to happen fast. And that is like, talk about a small percentage. But for those that want to do that kind of rocket ship, you need venture funding in order to put the boosters on the back of the business to be able to take off. And the other is, if you're in a space where there is a time threat competitively, if we don't attack and take market share now, we won't have an opportunity to later because other people will do it. And so we need to accelerate our path to market to get a presence so that we can actually take it before someone else does, because the job of convincing a customer to switch from them to us is a lot harder than getting someone to switch from never having used anything to using us for the first time. It becomes a competitive pitch instead of a value add pitch. So I'll pause there because that was a bit, but that's sort of like the false assumptions.
Yeah, no, that's good stuff. And Nathan, I guess just to kick us off, what would you share in terms of the topic and what you see?
I think my kind of thoughts listening to Brian there is it's so important to think about this in terms of a process, right? You're not just going to the US or wherever it is, wherever the location is that you're raising money. Brian just spoke about probably 15 different aspects of that, and without a process behind it, you're never really going to know what's going to be successful, where you're going to be successful, where the best place to raise is. And so I think really defining, like Brian said, what the outcome is, where you want to be in 8 years, where you want to be in 5 years, where you want to be in 2 years, and investigating your sources from there. I think that's the most important step, and it's usually a step that we see companies not taking because they're so just intrigued by the US market, the funding available, and they see people signing checks and they go and take them. So that's where my mind immediately goes, which is what Brian is saying is just kind of crazy, right? That there's so much decision to make, and it's so important to just kind of take a step back, look at your process, and go from there.
So I'm a sailor, and so I kind of equate everything to maritime metaphors, and so I'm thinking about that sort of sailor who is, sees the mermaid off in the in the distance, and they go into the water to swim with the mermaid, and they end up drowning because the mermaid is just a mirage.
Watch for the sharks. Yeah,
exactly. And so it's I wonder how you would react to this. So other than the industries that we know that are heavy R&D, like some parts of life sciences and some parts of energy that are kind of exceptions in this. Would it be fair to say that the only place where investment comes before sales is in the dictionary?
Yes. Yes, as a rule, that has few exceptions. You listed a couple of them.
Hmm.
So anything that needs like FDA clearance or technology is being developed out of a corporate or a university laboratory, these are highly capital intensive. They're not going to market until they have spent, what a software startup would consider a B round of investment. And so that's exception one. Exception two is I'm seeing less and less frequently, which is the explosive user growth, and like, let's not think about business model, just users that and that's much more of like a Silicon Valley mindset. But even 5 years ago when we ran a program in San Francisco, almost all the early stage investors we were talking to were looking for 20K MRR for $1 million seed round. So even there, that's changed. I think that still exists, right? If you can prove to one of the big internet companies that you are able to acquire users unbelievably rapidly in a demographic that they care about, they will monetize it. They don't need you to monetize it. They just need you to acquire those users and keep them engaged. And that's like Instagram was making zero money when they were acquired for $1 billion. There's 100 examples of companies like that, but that is such a small exception to the rule. And back to the sort of like false assumptions or like incorrect thinking about the US market and funding. Sales, as you said, sales comes before funding, period. People want to come to the US a lot of the time as a funding market because so much of the world's early stage risk capital is here. As I was saying before, those early dollars were here and people needed to come for that. Those early dollars are available more prevalently around the world, but the later dollars are not. It's not easy to find, even in Europe, a large community of investors investing in a Series B or a Series C. Either way, you don't think about the US as a funding market. You think about the US as a sales market. And then if you're able to sell here successfully, then you qualify for funding. So, we're talking to companies all the time, and we run a lot of programs to help companies rapidly sort of become US investor relevant. But the list is, you need to be a Delaware C corporation as your parent entity, right? Where all of the technology is owned by the US entity, and then whatever foreign entity you have is a sub. You need to have a founder, if not multiple, on the ground here attacking the US as their primary focus. You need to have a minimum level of traction. The next question we get is, well, how much of that has to be in the US? Like if they require, as I said before, 20K MRR in order to, participate in a $1 million seed round, does all of that have to be in the US? The answer is no. And not even a lot of it really has to be in the US. You have to have enough to prove that whatever you got to work to generate that revenue at home, when we invest X dollars into social media, we acquire users that have a lifetime value of Y. When we reach out to 1,000, B2B prospects, we connect with this many and close this many deals. And this is how much it costs for us to do that. And this is how much we make on them. And that is, sort of the proof of there's a profit. We're making more than we're spending. As long as you can prove that math that you got to work at home also is starting to work in the US, and then it's not like an anomaly or something that works in your market and not ours, then you still sort of check the box of traction. But without that, you're not able to raise here. And a lot of the time people throw that investor thinking of, I'm not investing outside the United States, as this ethnocentric, not a phenomenon in the United States, right? Of people that are like, oh, I invest in American companies because like America's number one, and that's our attitude. That isn't. That's not the reason why the market is that way. That there may be a handful of idiots that have that opinion, which I clearly don't share. The reason we built our business is because we knew we knew that there were so many innovators around the world that weren't getting funded, and they needed to try to get here. And we wanted to create more successes than failures because people were having such a hard time doing it, making what seemed like very logical decisions that were incorrect assumptions, and then failing on the way when otherwise they could have been successful. The reason why the market is that way is because in VC at an early stage is about relationships. It's a people game. It is not like it is activist investing, right? This is not like I'm buying stock and then, closing my eyes and knowing that it's going to go up over 5 years. This is, I am going to help you. I need to be able to say, as an early stage VC, your probability of success as a company has now increased because I will de-risk it for you a little bit because of the things I know and the people I know. And so when you are based, right, if you do apples to apples, I'm a New York VC. I have a company that is in sports tech and whatever in New York versus, or even in Boston versus in London. I can meet more often. More of my time zone overlaps. I have lawyers already that are on, retainer that understand the complexities of owning equity here. I don't have to worry about, I understand how the market works here, and markets are all different. And we're normally saying that, talking to companies saying whatever you did at home might not work here. Like, you have to find product market fit again. But also from an investor perspective, they know how the market works here. They don't necessarily know how it works there. And so apples to apples, they're going to be able to help the company that's near them, right? That can take meetings with the people that they know, around New York in the tri-state area more than they can someone from another market. So their success of their portfolio is higher if they invest in companies that are closer to them, and their fiduciary responsibility is to their investors, to their LPs. And that is the reason that the market is that way. Venture is a local game, and you'll see the same is true for investors outside the United States, because that holds for those markets as well.
Just on that, Brian, do
Yeah.
you think you can convince, and I've seen some success, and I'm curious your opinion here, when you speak about, flipping as a Delaware C Corp, and that kind of, that notion is really important for investors, but can you convince investors that flipping as a Delaware C Corp is just another maturity metric, like monthly revenue and traction? Is that something you think is possible as an outside entity? Because I've seen some success and and sometimes it doesn't work. So given your background, I'm kind of curious.
This is like, Bill, at those events when you put the person in the audience with the question you really want to get asked, and then they raise their hand.
He's
and
the
they
he's the softball guy.
Exactly. Exactly. So the answer is yes. Not always, right? A lot of investors are just, we have our process. It's a numbers game. A lot of investors will look at 1,000 companies for every one check they got, right? And so they're just cranking the process and running the process, and they're not trying to change anything, even if it seems like it may make sense. For those that are a little more open-minded, one of the things, Bill, that we try to convince US investors of, to Nathan's point, is that here are all the requirements that you have. We understand them because we've spent 8 years figuring out the requirements that US VCs have, whether it's a geographic one or traction one or whatever. These are your requirements: this much revenue, this kind of entity, blah 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 blah. We know that you're meeting with companies that are earlier than that because you're filling your pipeline, and because you generally take 6 to 12 months after meeting a company to invest in them, right? So you're meeting companies that are earlier that don't fit your requirements yet. We are trying to get investors to look at their geographic location, Delaware C Corp, proving traction in the US market as a metric that can mature in that period of time. And so don't exclude these companies because they haven't done that yet. You're meeting with companies that are doing 0 revenue, requiring them to get to 20K recurring monthly. I'm trying to introduce you to companies that have actually already gone beyond that and just need to become a Delaware C company and prove that that also works in the US. I can achieve that in under 3 months. Your company with 0 revenue is going to take at least the next year to get to that number. And so look at geography as another maturity metric, and that you can meet companies that are earlier to fill your pipeline of deals, as long as they otherwise are in the industry that you care about, have the maturity that you care about, right? As long as it otherwise fits, it's really just another maturity metric, and often one that takes less time than the others that you're sort of forgiving companies for when you're meeting them for the first time.
That makes a lot of sense. So So this is great. It's been great. So Nathan, Brian sort of started us down the road of talking about, if we're looking at various alternative paths for companies coming into the U.S. to fund. Brian's taken us down the path of how do we prepare and attract the VC investment. But maybe you could identify other alternatives that a company might look to be able to fund their U.S. market entry.
For sure. I mean, there's plenty of other opportunities. One that comes to mind is, crowd equity. Can you, for A, B, C, and D, can you get the crowd involved at A and get them more involved at B and C and D and really see how you go there? Otherwise, the other obvious one that comes to mind, which is really attractive for early stage companies, is the angel investors, right? It's reaching out to those people who qualify for you, not because essentially they're actively investing, because they're so relevant to your company because of A, B, C, D, E, F, G. For a few different reasons, they can support you not only possibly financially, but with advice and with other kind of network support. I think that's a huge opportunity in terms of alternative funding opportunities.
So what I'm hearing is sort of a strategic type investor whose value is well beyond the money. It could be advice or connections
for sure. It's all about finding that person who is going to springboard the startup to that next level, right? Without the argument is, we don't really need your money. Really, we need your support and help. And if there is a partnership down the line, then that's great.
Brilliant. That's great.
I think it's such a good point. And one of the things that we see is it's founders or even organizations like ours that are meant to help companies with identifying investors and setting a fundraising strategy. The angel aspect is almost always untapped. And so the degree to which they run down angel investors is wholly incomplete from what we've seen. And what I mean by that is they're going to go find angel groups, which are the biggest hubs. And that's where we start too. And we work with, New York is great and unique in that it actually has the biggest angel community in the country, even though people think it's in Silicon Valley. It's not. There are, I think, 10x the number of angels in the tri-state area because we have 10x the population of San Francisco. But it's and then you're going to go find the angels that have invested in other companies before, and you're going to find them on Crunchbase if you can, or wherever else. There's just a much larger world. We see this done really well within finance in New York, where you have someone that worked in whatever aspect of finance. They were in trading, or they were in asset management, or they were whatever. And there's an understanding that in that industry, people generally make enough money to be able to invest in things. And so they'll reach out to everyone they've ever known or worked with, or anyone that worked in their industry, and say hey, you get what I'm doing. You're in asset management. We're building some asset management solution. Become an investor. And they'll find 1,000 people or more on LinkedIn that fit that, and go tap that. That exists in every single market and is almost always untapped. And so one of the things that we've started doing as a part of this really gets to process, which Nathan was talking about earlier. And he is our program director, but he's really also our ops director, and has built the entire database that our business is built upon. And this is an important part where the process for finding angels for us now is also includes identifying hundreds of companies that are in the market of the company that we're working with, but are non-competitive, and then finding their senior leadership and reaching out to them and saying, you should consider being an angel investor and funding. By the way, worst case scenario, if not, maybe be an advisor, because you know so much about the space and could be a great strategic partner for us.
And it seems like this is an area of opportunity, because I guess my impression is that most of the investing process is sort of one direction. In other words, the company that's looking for investment, is building a great pitch deck, and they're doing all, sort of the presentation, and they're responding to questions. But I'm wondering if part of this, area that we should talk about as well, or what are the top questions that a founder should ask of an investor, particularly thinking that an investor is well, really a couple things. One is they're certainly worth much more than the money they represent, but it's also probably very important that they see that you appreciate the fact that they're worth much more than the money that they might bring to the party. And so I guess when you think of sort of the key questions that a founder might ask of an investor, what comes to mind for you?
I
Go
Brian, we
ahead,
gonna jump
Nathan.
in?
Yeah.
Look, I think number one is like, where have you seen successes and failures in this space? Like, at what point have you seen companies succeed? I know not so much competitors to us, but generally in this space. And at what point have you seen them fail? And I think that perspective of someone who has seen so many companies most likely fail, right, is vital. And I think that's a fantastic place to start.
I love this question, Bill, and I think it's one that founders don't ask themselves. I think that like one of the things we try to coach founders to do is to act as if they're going to be the company that's turning away investors. Act as if you have choice, the kind of choice you never imagined. Because most people come at this and they're looking at like the end of their runway. They're looking at like when their funding runs out and their business is going to die, and they're like, "Oh my God, do you have money? Can we talk?" Because like you have money,
we have one week.
and like. Yeah, exactly. Yeah, even if it's 6 months, it's like that's just an uncomfortable feeling of like, all this is dead in 6 months.
Right.
And you need to think about it more strategically for a lot of reasons. One is because investors want to know that you're strategically thinking about it. Like, why is that a good investor for you? But they get stuck in that headspace and they don't flip over to the other side, which is, well, why are you a good fit for me other than your money? And it reminds me of like when co-working spaces were exploding, sort of like post WeWork success, and every co-working space is like, we're not office, we're community, right? And VCs, and like being a recovering VC and having been on the other side, I could tell you this is, they're like, we're not money, we're value, we're partners, right? We're like a network and we have experience. And the percentage of investors that actually do that effectively is tiny. It is tiny. Most of them do not live up to the promises that are made. And it's not, and a lot of time it's not like a dishonest thing. It's they want to, but they're busy, right? They have a lot of things to focus on. Running a venture fund is not an easy thing to do successfully. Like the percentage of funds that are successful is actually also really small. It's like less than 20. And so it's really important to ask those questions. And I think, there's an aspect of the questions that I think are process focused, and there's another aspect of the questions that should be like sort of market focused related to your business. So the first ones are, what is your normal process for evaluating a company and making a decision to cut a check? And you want them to verbalize that for you, because then you're going to hold them to it, right? What's the normal timeline? And then when you ask them the normal timeline, they're going to probably quote the fastest deal they've ever done, right? They're going to say something like, "Oh, well, like our partners have our meeting on Monday, and where we talk about all the companies that we met. And then, if everyone's on board, then we'll probably have a meeting like within 1 to 2 weeks after that. Then we'll do due diligence after that for probably like another, 2, 3, 4 weeks. And like, then we'll be ready." And most investors are meeting a founder and they're not. If we looked at a big cut of venture funds that we work with, and then we were talking to them to identify the first day they met and then the day they cut the check, right? And the average for funds is between 6 and 12 months. It's not that super fast process timeline. It's just not how it works most of the time. And so understanding that process, because because like every founder is often coming into this with like, we're closing in July, right? And if we don't close in July, everyone that we talk to is like, well, why didn't we close in July? What's wrong? What, and that kind of stuff can like tank your round. And so being able to run a tight process and manage, it's one of the hardest things to do with fundraising for a founder, is to create urgency and manage the close to get investors to take action when they always would prefer to wait another month. Almost always. And so it's really hard. So understanding the process and then asking them to like tell you about the process for the last few deals that they've done, like make it real, because that's not like what they are dreaming. It's what actually happened. You'll get more honest answers. And always talk to existing portfolio company founders before and it's not hard to do. Like reaching out to a CEO and saying, hey, you raised money from XYZ fund 3 years ago. We're in the midst of due diligence conversations with them now. Like, how has it been having them, involved? Are they on your board? Have they been really active? And you'll get candid feedback a lot of the time. So process, super important. And then if they're going to say they're going to be able to bring value, go talk to a company that's like, you're a media tech company, go talk to some media tech companies they've invested in before to understand how much value they were really able to add. Because again, it's like most aren't really bringing the value. And so that kind of homework can be really valuable in choosing the right team, because it's not just like, hey, cut a check because I need to survive. It's like you're kind of like handcuffing yourself to these people for the next 8 to 10 years. We always talk about how it's not like finding a boyfriend or a girlfriend. It's like finding a husband or a wife, right? This is like it's a serious long-term commitment. So
yeah, and it as you were talking, it so much to me feels like the process. And I'm always amazed when I interview people, how few people have questions. So tell me about the business, and what's the ethos here, and what happens if, and all those types of things, where to exactly what you're saying, it has to be a mutually beneficial process, and there's got to be it's got to be much deeper than a paycheck on Friday or funding, in terms of how we're going to relate, because we're going to spend a lot of time together, and there are a variety of expectations that are going to be there, and if we're not going into it eyes open, it probably won't work very well.
It's a neutral dynamic.
Yeah.
Right. You have a community of people that cut checks, and you have a community of founders that are chasing dollars. Right. So you have like, and so the power dynamic is dollars and founders.
Right.
What's hard to get into founders' heads is that a lot of the time, like it actually, the reality is it'll get closer to here for the deals that investors want to do, if not even founders have advantage, because you're the ones that create opportunity and value for them, right? And at the top of the game, they're competing for deals, and it's hard to get out of that mindset, because everyone's going to pitch events and running up afterwards to go talk to the investor on the panel,
Right.
in a line of people that are waiting to talk to them, and they're used to saying no all the time because they're getting asked for so many things from so many people, and they have to say no in order to just create efficiency to be able to even get their job done. But when you get in the room and it's a human and human interaction, like you have to let that go if you want to run the process really well. And that kind of confidence will take you really far in those conversations as well. And the one thing that we, for people that say, well, like, how do I get there? It's like anything else, like get educated, understand what the dynamics of seed versus series B are. What does the process run like? There's so many blogs, there's so many books, there's so many people like you and me that have been there and done that 1,000 times that can help. Find a lawyer that's like actually a venture tech lawyer that does hundreds of deals a year, that understands it. There's a lot of ways to get there, and if you come in more sophisticated, it takes you a long way, and that costs like 50 hours on YouTube instead of watching whatever cat video bullshit you're watching, to get boned up on it.
How do you really feel?
Yeah.
Love cats, by the way. Have two. Love cats. Okay.
So Nathan, maybe one question for you to close us up here on this topic is, so I remember this finance teacher I had who was one of my favorite teachers ever, and he had this saying when he was talking about raising capital, and he said, always look for money before you need it. And I would, as Brian was talking about, that this timeline that often is quite short for companies raising money. How does a company really think further ahead in the process and make sure that, it seems to me that you're least attractive when you're desperate for money, right? It's the more desperate you are, the sort of the less attractive you look. So how does a company sort of avoid that pitfall?
100%, and it's all about just aligning your US expansion plan and your fundraising plan with the business plan, right? So if in 2 or 3 years you hope that profits are X, your monthly revenues are Y, start making those decisions. Start not only thinking about fundraising, start thinking about when's the right time to incorporate, right? Start thinking about getting your immigration plan in line so that when you're, given the state of the world right now, that's a very, very important thing to think about. And making sure all of those little steps are in line. So when it does come down to the fact, when you're on the ground, you finally get some meetings, you've already ticked 10 boxes and you're kind of ready to have those high level conversations, right? And so I think it's really, like I said at the top, thinking about where the business is going to be, the trajectory of the business, and aligning all of the little puzzle pieces we've kind of got to today.
Oh, that's fantastic.
There's
So,
one tactical thing that we
yeah.
do related to that, Bill, that I'll throw in there quickly. And I think like the other way of saying what you said is that, something we hear founders say, which is like, you're never not fundraising. And when you think about the fact that investors want it, like, whether they want to or not, they're meeting you 6 to 12 months before they cut their first check in you. It's like, okay, well then how do I, I'm not raising for 6 to 12 months. So like, how do I do that? What we've started doing and helping companies do, and it's something that I learned like probably 6-7 years ago, just from a couple companies that I saw doing it, and then we copied it and made it ours, is running a newsletter that goes out to prospective investors and to influencers. And it is really simple. It is, people are like, man, how am I going to send an update on my company? I don't make progress every month or every 6 weeks. You do. There's enough going on there to do it, for everyone we've ever tried to do this with. And what you're doing is you're just sending out basically metric updates, which are showing progress, and you're creating the thought in someone's mind of growth. And it's like, oh, well, when I saw this newsletter, it was here and now it's here, right? Like, wow, they're actually like executing on that plan. And then the other is you're putting asks out to a very influential, connected, and intelligent community. And people generally innately like to help if they can, and it's easy. And so we've created something called the Investor Prospecting Newsletter, and we help companies create a template for it and then coach them on how to update it regularly so that it's not a big lift. And what it does is just really, it's almost like the fundraising version of a marketing nurturing campaign, right? When I'm raising, it's sales. When I'm not raising, it's nurturing, it's marketing. And all you're doing is staying top of mind, and you're reminding them of who you are and what you're doing, and also setting yourself apart from the 1,000 other founders that they met who aren't organized enough to put something like this together to keep them up to date.
It's funny that you say that, because I'm on a few of those lists, right? I get those.
They're always the best founders, aren't they? It's always.
Oh my gosh! I mean, as you said, it's
together to do it.
It's a very small number, as you said, that do it, but those that do it stand out. It's like people that write a handwritten thank you note or anything like that. It so separates you. And I have an old boss who he ran many offices, and his evaluation of the office when he first walked in, wherever he was traveling to, was actually to go in the bathroom, and the assessment was, if these people can keep the bathroom clean, they're probably doing a pretty good job. And by and large, it was a pretty good metric for how people managed the business, and it worked out really well. But I think you say a lot about yourself and about your organization when you have that kind of organization where you can communicate not just consistently, but also with thoughtful information that helps people get insight as to your progress. I think it's such a great tip for sure.
Most people don't even follow up.
Right, 100%. Yeah.
So when you follow up effectively and continuously, it's a game changer in how people view you.
The statistics around follow-up are, as you said, consistently.
Makes all sales managers just shake their head.
Absolutely. So before we close up, let's take a couple minutes on VentureOut and make sure the audience knows what you guys do and who your program is appropriate for. But do you want to kind of give us a thumbnail in terms of VentureOut and who you serve?
Yeah, and I always am long-winded. It's probably clear to anyone that's watching this. So I'll do my best to keep it quick. So we've been around since 2012. Our original focus, and still our primary focus, has been promising entrepreneurs from around the world that are looking to break into new markets, specifically into the United States. We're running our programs in person in New York City. We have simple, short, small ways of engaging with companies. We're running, virtual 2-day intensive programs for companies built around specific sectors. We are running 1-week sector focused programs in person in New York once the world opens back up. We've run that kind of program. That was sort of our first offering. We've run it like 160 times for almost 1,000 companies. So, we've got a lot of experience and a big network that we bring to the table to help companies when they're really trying to figure out breaking into a specific sector market and who the thought leaders are and who the investors are in New York, or if they're trying to figure out breaking into the US market from abroad. And then we run a 3-month accelerator, which is really a US launch accelerator for foreign companies, where as a part of that program, if you're not already willing, we will incorporate you. We will get you on a path to your business immigration visa to be able to stay and work here. If you don't have traction in the market, we'll help you gain that initial traction. We'll help you set the stage for being able to raise from US investors, which again always starts with the sales and the traction and the incorporation. And then something that we developed, we always worked with cohorts of companies, either that we put together or that were put together by our partners and our clients, who are often foreign governments or foreign investors. But in the midst of the pandemic, we started working much more closely one-to-one with companies. And so, with that, over the last year, we've developed an advisory and growth practice where no matter what your company, what aspect of tech, whether you're trying to break into a new market or not, if you're looking to figure out how to scale sales, marketing, fundraising, you're looking for a US expansion plan, you're looking for when I break, what are the first things I do to break in? How do I start selling before I have to move? All of that stuff. If you're looking for an hour of help, or, we have like ongoing engagements that are now, over 6-7 months long, any level of engagement. And that's been super fun because we talk so much about things like the investor prospecting newsletter, and I've written 4 of them over the last 3 weeks for companies. And so we're so much more in the weeds, and it's so much less academic and more tactical, which has been a lot of fun. So anyway, early stage tech companies to companies that have 30, 40, 50, 60 employees and are looking to break into the US market. I'm focused on, helping as a mentor and advisor and consultant to a lot of the companies and engaging with some of our biggest clients. Nathan is our program director. He runs all of the programs, as a project manager. He's also our ops manager. So he built our Airtable database, which powers every single thing that we do in a really structured and organized way, which is we could do a whole nother thing on.
Don't get me started there.
Yeah, we just can't, Nathan. You can't do any high risk sports because we can't afford to lose you. Because
yes, exactly. This is one of those classic scenarios of if someone gets hit by a bus, what's your plan? It's our plan is I don't know.
So yeah, Nathan. Yeah, no more of those high risk sports for you.
All right. Well, I better stop hanging out with Brian then, because the risk usually comes when he's involved.
There you go. So
high risk tolerance.
Yeah, exactly. Or we can just put you in bubble wrap. There are alternatives to this. So Nathan, anything that you'd want to comment on with regard to the program?
The last, there's a million things I'd like to comment on, but Brian covered that really well. The last thing I would say is that we love what we do, and we have a hell of a lot of fun doing it at VentureOut. And so, at all of the logistics points that Brian made, we love it. We have fun. If the day ever comes, you come to our New York office. We also show you a great time and really enjoy working with you. So that's all I'll add.
Brilliant. Well, good. So when we publish this, we'll certainly put links for you all in and tag you and all that kind of fun stuff. But is there a preferred mode of contact?
Email, social media, carrier pigeon. We're easy to get in touch with. Our email addresses are all at ventureoutny.com. You can hit us up on social media. Yep. We're easy to get. It's Brian at, it's Nathan at, it's, it's pretty straightforward stuff. But, for people that whether they want to get directly in touch, that's easy. If they're not sure, you can sign up for our newsletter. We have events going on every few weeks that people can just sign into, because everything's, online and virtual now, and will be going forward even when the world gets back to normal. So it's easy. Come hang out.
Yeah.
Like Nathan said, we want to have fun. People are like, this game of venture and startups, it's like all consuming. There's like a lot of the time it's a problem. There's like not a good balance between work and life. They kind of blend together. And so like my whole philosophy has always been, if that's the case, we better be having fun while we're doing it, because otherwise my life sucks. And so we're, even in the midst of the hardest, most challenging stuff that we have going on, personal and professional, smile on the face, high five in the office, and let's go make some shit happen.
Absolutely. No, it's you got to stir the pot for sure. Well, this has been great. And to our audience, thank you for being a part of this podcast. And please tag us and like and subscribe and all that fun stuff.
Bill, thank you so much for setting this up. This is awesome what you're doing.
Thank you, Bill. This
really
community you've pulled together, it's some organization and community, real community in it has been needed for a long time, and the work you're doing is great, and we're super grateful. Thank you for the opportunity.
It is very kind of you to say, and you guys are such an important part of it. So all we care about is helping companies get into new countries as safely and productively as possible. So it's all good stuff. I wish you guys a great rest of your day and a great weekend. And thanks so much for sharing all of this wonderful wisdom with the audience.
And to you, Bill. Thank you.
Right. Cheers.
Cheers.